Hey there, traders. It's ASIM Trading again. I just wanted to do a quick video. I know I've been busy with work and school and just life in general, but I thought I could spend a good 15 or 20 minutes giving you some content. So I've been getting some questions about um, stops, trailing stops, profit targets, a whole bunch of different questions in the threads. And so I just wanted to kind of go over my framework that I use when it comes to thinking about these things. And I want to emphasize that it's a framework. People look for these clear cut answers to everything in trading, and it's just sometimes things are just not that simple because stocks don't unfold exactly the same. Uh, Stocks almost have their own unique character in the way that um, the price action unfolds as the stock is making its move, and it's different for each stock. So having these kind of canned answers that are supposed to cover every scenario is just it's just not possible. But you can have a framework, you can have a logical process through which you think through these things as you're watching the price action unfold. So typically what I do is, the good thing about TC2000 is you can kind of back the price history up. So I can actually kind of show you some of these things. So as I pointed out in my post on social media, SOUN, it was kind of forming this triangle pattern, intraday high tide flag for whatever you want to call it. On the daily over here, you can see that the price bars were kind of like just chopping around within this tight range. The day before the breakout, the 2 days before the breakout, you have these nice white candles, which means the price range of those 2 days is below average of its average range, which that's a good sign. You want to see this sort of tightening of the price action as the pattern develops to the right. It might start off wide and sloppy, but as it moves to the right, you want to see this thing getting tighter and tighter, and that's where you start building these higher lows. And you kind of, like I said, you kind of before you have this lid on the supply. So every time the price bumps into it and pulls back and bumps and pulls back, the lows start getting higher. The volume down here starts to contract. You can see as this price pattern unfolds to the right, you can see the volume starts to contract and really dry up in this pattern. And that's kind of how you know that it's getting ready to make some sort of move one way or the other. You don't know if it's going to break to the upside, to the downside, but just those are good indications of what to look for. When the volume here is still super high and things are just chopping around, um, those situations tend to be a little bit lower odds. But when it starts to tighten up and get really compressed, that's often when I start looking for some sort of breakout pattern. And I mean, to be honest, I tried to trade this thing on this breakout day here, or not day, but hour. And you can see it started to kind of tighten up, and then it had this breakout candle. But, you know, even though it started off initially decent, it sold off, and then it kind of just chopped around, and then eventually I got stopped out of it, I think right here. And, as this pattern unfolded, on this day here, when it gapped up and reversed, like I was about to actually re-enter this trade because I thought it was going to take out this range here and be off to the races, but it opened up and immediately reversed, and it never actually recovered for the rest of the day. I think, like, it came close, it didn't have what I was looking for, so I didn't actually end up getting in on that day. When it's actually, I thought by the time it tightened up here, I thought it was going to break out the next day. And this is the thing when it comes to watching price action, is you don't know how it's going to unfold. You can speculate, you can look at tendencies, but nobody can say they know for sure what's going to happen until after the fact. So you can look at this thing, and like I thought it was going to break out here, and it didn't. It just reversed, and then it just kept on kind of selling off. But you can see every time it sells off, the lows get higher and higher. And then this was on Friday. This thing is starting to get tighter and tighter within this sort of compression pattern. And then on Monday, it broke out of there, and I got it here at 398. And so the first thing I do when I get into these patterns is I calculate the distance between my entry and my where my stop is, and that's what determines the size of the position that I'm going to take. And I have a previous video discussing the math behind that. And whether you use the low of the bar, the breakout bar, or whether you use something a little bit lower, I tend to use recent pivot lows as my reference point. You can use the lower Bollinger Band here. There's different options, and it's really just about trade-offs. The tighter you get your stop, the bigger your position can be, but the more likely you're going to get stopped out on just random noise. Whereas, the further away you put your stop loss, the smaller the position will be, because you're having to compensate for that further stop with a smaller position to have the same amount of risk. But your stop out rates are going to be much lower, and your batting average is going to be higher. And like I said, that's the trade-off that I choose to accept, is to have my stop a little bit further away. I'm not talking about like way the hell down here. That doesn't make any sense. But if it's people sit there and be like, oh, it needs to be as tight as possible, like under the breakout bar, and it's okay, do that if it works for you. I just my experience doing that is I get stopped out a lot, and then watch the stock immediately turn around without me, and then I would have to re-enter. I'd rather get in once, have the stop a little bit further away, not get stopped out and have to enter 2 or 3 times. That's just my preference. I don't want to beat that dead horse anymore. But I put my initial stop, and then I have some ideas on where I want to take some initial profits. So this is actually where I ended up taking a partial, and people have different philosophies on how they want to take partial profits. Guys like Dave Landry, he takes half of the position off at 1R. So essentially whatever his risk amount was on the downside, he goes 1R to the upside, and he takes half of the position off at that 1R risk level. Some people use 2R, some people use 3R. Marios, who was recently interviewed by TraderLion, I think he uses 2.5 or 3 ADR. So basically whatever the 80, so like this ADR is 12% on this stock. So let's say his buy point was $4 here. He would basically take off some amount at 2.5 or 3 ADR. Again, there's just trade-offs and pros and cons. The further away your initial profit target is, the less likely it's going to get hit. But you also are waiting longer to lock in those gains, which means you have a much higher chance of having more of your capital at work for that bigger gain. Whereas if you have your initial profit target somewhere closer, you're going to hit it more regularly. You're basically going to be locking in those kind of like, think of it like base hits, getting on first base in baseball. Like you're getting those consistent base hits, which it racks up gains. It helps smooth your equity curve out a little bit. It takes a little bit of money off the table, and that money can be allocated towards another trade that might be setting up. Because there comes a point in time where, especially once a rally gets kind of longer, you start to run out of capital, essentially. Like you don't have enough money left to buy new positions. So a good thing that taking partials does is it frees up some capital, so you can actually redirect that capital into fresh breakouts that might be happening. So again, I entered here, my initial stop loss was here, and then, once it hits a certain amount, I take some partials off, and then it just keeps on going. And then I took off, I think I took off a third here just to lock some profits in, and then I think I took off, if I recall, it was another third, not a third of the whole position, but like a third of what was left. So like, this would leave me with 66% of the position. And then if I take off another third, then the math is escaping me right now. But it's like I just take whatever I have left and I just knock another third off. So I still have a pretty large chunk of that initial position still left. And so once my initial profit targets get hit, the next thing to think about is, okay, when do I start trailing the stop? And at this point, what I often do is use the 10-period moving average as my trail. But you can see where my cost average is and where the 10-period moving average is. It hasn't actually caught up to my initial stop, and it hasn't actually caught up with my cost average. So what I tend to do is I wait for the 10-period moving average to catch up to that initial stop, and then as the 10-period keeps moving higher, then this initial stop loss will start to trail up until it hits my my cost average. And then once the 10 period catches up to cost average, then you're just kind of trailing it from that point. So we just keep stepping this thing along. So I bought here, initial stop here, I took a couple of partials, and you can see where the 10 period moving average is. It's now beyond my initial stop, it's now beyond my cost basis, and so as this stock continues to move higher, I will continue to use this 10 period moving average as my trail. So that's just the basic idea. What I'm really doing is, and this hasn't made any pivots yet, but if you look at this prior price action, when this thing makes a pivot on the hourly and kind of recovers from that, and then you have this new pivot low, I will often put my stop at the lows of that pivot, and then I'll keep it there until the 10 catches up. And then when I get a new pivot, I'll move it there, and then when the 10 catches up, then that's my new trail. And I just basically use a combination of the pivot lows and the 10 period moving average as my trailing stop. And, so this is SOUN. If we do another example, I've actually been in app since, what is that, the 15th. So I got on this gap day here, my stop was at the lows, and you can see this thing just kind of chopped around for several days, 1, 2, 3, 4, 5 days. It actually chopped around for 4 or 5 days. Didn't really go anywhere. But as you can see, this thing looked like it was going to make a pivot low here, and then it didn't actually like break out. So like this isn't a valid pivot low, and then made another pivot low, and then finally here it actually it bottoms out and it starts to creep up the right side of the formation. So then I move my stop under the pivot low, and then once the 10 period catches up, which is about here, yeah, you can see that a new pivot low has formed and broken out. Okay, so then I move my stop under there now, and then you can you just see this interplay of okay, so now I'm at the point where the 10 period has caught up past my initial stop, past my second stop that I moved it to, now past my cost average. So now I basically, and this is taken out a little bit longer because it didn't actually move out immediately, but after, what is that, 1, 2, 3, 4, 5, 6, 7 sessions, I'm finally to the point where the 10 period moving average is above my cost average, but not yet to the point where I'm able to take a partial off. So I entered here first. I added a little bit on the 26th, which was Monday. So now I have a slightly overweighted position, and I'm basically at a free roll trade, a break-even trade. And that's kind of where I want to be, honestly. I want to have a free roll trade, which is essentially risk-free, and it's bigger than normal because I was able to add to it. I was trailing my stop up, and I'll just keep doing this until it stops me out. Who knows when that'll be. Sometimes these stocks can ride the 10 period moving average for weeks. Palantir is another good example. This is where I got in. This is where my initial stop was, and it hasn't really had a chance to even do anything. Like today, it had a pretty good close, but it wasn't anything impressive. It wasn't even above average range bar. So it was up 5%, but the ADR is almost 6%. So that's why this bar here is still white, because it's below average. And again, so one thing I want to note as well, this 10 period moving average on the daily, which is a 65 on the hourly, the closer you get your entry point in the vicinity of this moving average, the quicker it's going to catch up. So this stock has hardly moved anywhere, and I'm already at the point where this 10-day moving average has caught up to my cost average. That's a good point to be in. Whereas the further above this moving average you buy, if there's a gap between where you buy and the moving average, it might take a while. App was a good example of, I bought it here, stop was here. It took 4 or 5 days for this moving average to catch up to my cost. To catch up to the initial stop, and then another couple days to catch up to my cost average. And that's because my initial buy point was extremely stretched from this moving average. Whereas here with Palantir, my buy point is like practically at the moving average. So like the moving average is already almost at my cost average. So yeah, that's a good place to be in. So if this thing is able to break out and kind of move higher, then I now have this nice easy trail that I can use with the 10-period moving average. Same thing with Frog. It had this EMA, this wedge pop breakout on the hourly. You have these declining 10 and 20 on the hourly. It wedge pops through that. That's where I initially bought with my stop at the lows here. The lows of this bar. I mean, I could have put the stop at the lows of the bar here. I mean, that's a personal choice. And like I said, I use a framework. I just assess the situation, I assess the health of the market, and then I kind of make my best judgment from that. So sometimes I will put my stop at the lows of the bar, sometimes I will put it at the lows of the pivot. This didn't really have a nice clean pivot. You can see it was just kind of working its way lower, and this was the first time that it had popped back through the moving averages, which is that kind of wedge pop that Oliver Kell talks about. So, I thought this was a slightly riskier sort of situation, so I put my stop a little bit tighter. I probably should have added more here, but honestly, I wasn't around whenever this happened, so I didn't add to it like I wanted to. But as you can see, in this situation, I'm already at a point where this 10-day moving average is caught up with my cost average, and also it's about to be at the same level as this prior pivot. So again, as this thing keeps going up, if it continues to go up, I'll continue to trail it. And that's the thing, like I don't know either. I don't know if this thing's going to keep going up or not. I have no control over that. All I can do is get in at a good point, manage my risk, and manage the trade. And I have control over nothing else. Like we can sit here and micromanage things, and I think that's what gets a lot of people in trouble is they micromanage the trades. They're so in a hurry to crank the stops up and try to make sure that they get their stop as tight as possible as soon as possible. And that sounds good in theory, but really what it ends up doing is you end up over managing the trades, and you end up stopping yourselves out of perfectly fine positions on just normal noise because you want to be hyperactive with your stops. I would not recommend that. Be patient. Let your trailing stop do its work. You're not going to outsmart your trail, I promise you. You're going to regret it more times than not. Again, CLSK, same kind of situation. If you haven't noticed by now, I trade the same patterns over and over and over. You have a big move up. It starts to correct a little bit. Usually what that does is that turns these moving averages over on the hourly. So you have this, it starts to slope the 10 and the 20 down as they pull into this daily 10-period moving average. And then you start building higher lows. The price action starts to get tight. You can see the volume drying up as it moves right. It's the same story, different stock. When this starts to get tight and the volume starts to dry up, I am on watch. So that's why whenever these breakout bars happen, I step up to the plate and I buy the stock. I don't hesitate because I already know exactly what I'm looking for. And same thing, I bought the breakout of this pivot. I put my stop at the lows of this pivot. And then again, because this 10-day moving average was so close to my buy point, after a day or so, I'm already with a 10 period that's at my cost average. So that means, for all intents and purposes, I have a nice, easy, risk-free trade. And then, I can start taking partials if this thing continues up, and then I'll just manage the trade after that. And then this is my last position here. So these are all of the stocks that I currently am in. And again, same thing. If I look on the daily, these bars start turning white, which means they're starting to get tight. This down slope of the Bollinger Band, along with now you can see this top band starts to move down and the bottom band continues to move up. The stock builds higher lows. It's, like I said, the same story over and over and over again. You see the volume drawing up as the pattern unfolds and moves to the right. And again, I'm just looking for these breakout candles. If you see the high here, there's a high here. And you can, if you just imagine before this thing breaks out, like this is what I'm seeing on the chart the day before. And this is what you need to look for when you're looking for setups. I'm looking for highs that are getting lower, lows that are getting higher. The pattern is kind of overall compressing and getting tighter. And then when I start seeing this sort of action here where it's just getting nice and tight, the volume is extremely dried up, I'm on the lookout for a breakout. And the breakout candle is almost always going to be an expansion of volume and an expansion of range. You can see the volume comes in, and this is the first bar of the session. This is the first 30 minutes of the day. So when I see this big expansion candle and I see the volume step in, and usually the volume buzz by this point is pretty high, it doesn't matter what else I'm seeing. Like I've seen enough. Like that's all that I need to know to get into the trade. You can sit there and hyperanalyze everything else that overcomplicates it. If all the conditions and the criteria are met, freaking step up to the plate and take the trade. Uh, don't overcomplicate it. Trading is already hard enough. But again, I buy on the breakout. I put my stop at the pivot lows, and then I just let it go. I took a partial here at a function of my my stop loss. The 10 period caught up to my initial stop, and then as the price unfolds, by tomorrow, at some point tomorrow, I should have this 10-day moving average caught up to my cost basis, and then we'll see what happens. This thing could roll over and stop me out tomorrow, or it could go up for the next 2 weeks. I have no idea. Anybody that says they know is a liar, and they're probably trying to sell you something. So anyway, that's just my mental framework for how I enter the stock, how I set my initial stop, and how I use a combination of the pivot lows and the trailing 10-day moving average to manage the trade. Like I said, don't make it more complicated than that. I would say the only exception might be, and again, this could be a personal preference, but one exception might be is when the stock has made a big run, like let's say it gaps and then it runs for 4, 5, 6 days. And once you start getting into that range where the stock has been up for 3, 4, 5 days, 6 days, 7 days, and it's extremely stretched, you see this big gap between where the price is trading and the 10-period moving average. In those sort of situations where it's extremely stretched and extended to the upside, then you don't have to necessarily stick to this 10-day trail. You could start tightening it up. Maybe you switch to an hourly trail where you start taking some off, at this point that's much higher. Because if you wait for the 10-day, it doesn't catch up until over here. Whereas you probably could have taken a partial off or something here whenever it was stretched and extended, and it starts to roll over through the moving average. So that'd be the only exception to this sort of approach that I explained of using the pivot lows and the 10-day moving average is if you get extremely stretched from the 10-day, and you kind of have a series of 3, 4, 5, 6 days of up, or maybe it's out of 6 or 7 days or sessions, most of them are up, and you're kind of just getting stretched and extended, and maybe the volume is kind of drying up, indicating that the demand is not there where it was before. In those sort of situations where it kind of looks kind of climaxy or like a blow off top sort of look, don't wait for the 10-period moving average to roll over, because you're going to lose a whole bunch off the top. At least take some partials on the way up, and then maybe take a decent amount of it off if it rolls over through like the hourly 20 or something like that. That's a good way to kind of reduce some of the drawdown, because if you use these longer moving averages like the 10 or the 20, like the drawdown off the top, I mean, this one's not bad. This is 12%, but some of these drawdowns off the top can get pretty nasty. This is a 6% ADR stock, so that's basically like a 2 ADR drawdown off the top. But in some of these really, really highly volatile stocks, that drawdown can be a lot higher. It can be 20, 30, 40% from just going from here down to like the 20, or going from here down to the 10. You don't really want to be taking like a 30 or 40% haircut just waiting for a trail to get hit. I wouldn't recommend it anyway. But anyway, like I said, I would just use this as just a mental framework if it's helpful for you. Think about where you're going to get in, where your initial stop is going to get placed, and then from there, your job is just to figure out, how do I use a combination of these pivots, these hourly pivots, and the trailing 10 to manage the position. And this isn't perfect. There's going to be occasions where you get stopped out and then it reverses and goes up without you. And it's just like you're not going to be able to cover every single scenario. It's impossible. But you can have a logical framework by which you approach trade management, and that's kind of the idea. So find an initial stop placement that works for you. Find a way to trail that works for you, whether that's using the pivots and letting the moving average catch up like I explained, or you could just use the moving average as your trail and not do the stepping up with the pivots. Again, like whatever works for you, just do that and do it consistently so you can learn the pros and the cons of it. Because everything you do, there's going to be some pros and there's going to be some cons. There's going to be trade-offs. I keep saying trading is all about trade-offs. And then the last thing is just find a method for you that works for taking partials. Whether you take a third off at 3R, or you take half off at 3 ADR, like just find something that works for you and do it consistently. And then you'll find over time what works. And as you study and backtest and look at your logs, you'll start to understand what works best for you and for your mentality and the way that you like to manage your trades. So I hope you found this helpful. Leave me some comments in the comment section if you have any further questions. Thanks.